Greetings on behalf of your financial team at Paul R. Ried Financial Group and myself, Paul Ried. Well, I want to talk to you today just as if you're sitting right across from me at my desk. I want to talk about the market turbulence. Just like you have, I've recently read headlines, and this is in the Wall Street Journal today. It says Dow plunges 7.8%, oil prices post biggest slide since the Gulf War in 1991. It says yield on 30-year bond falls below 1% for the first time. That's enough to shake you up a little bit. And what I want to do during this video is really share thoughts in three areas. Number one is provide some perspective on current market volatility. Number two is remind you of how your portfolio is structured and what we're doing behind the scenes on your behalf. And then finally, number three is really make some suggestions about what you could be doing right now. So first, let's think about a market perspective. We're going through some turbulent times. Many of you have perhaps recently read our market letter. There's a link to that if you haven't at the end of this email. Also, it's posted on our website. Well, in that letter, we reflected on a quote, and it simply says this. It says, history doesn't repeat itself, but it oftentimes rhymes. Well, let me elaborate on it a little bit because it does relate to what's going on right now. The markets are always volatile, and frankly, every time they've gone down, they've come back up again. But you know, the events are different. Markets seem to have some patterns, and events are different. Let me take you back a little bit in history, and some of you may remember this. Going back to 1986 to 1989, you might remember, we had Black Monday, we had bank failures, we had problems with junk bonds. Well, the market went down and came back up again. Then in 1997 and 98, we had Asian stocks tumble, and we had a global economic turmoil. Stocks went down, came back up again. And then in 2003 and 2004, that was when SARS was there, and we had the U.S. invaded Iraq, oil prices soared. And then, of course, 2001 and 2, we had Y2K, we had 9/11. What we had was the internet bubble that burst, and there were corporate accounting scandals. Well, the market went down significantly and came back up again. And then, of course, 2007 and 8, that was called the Great Recession. That was a time when we had a subprime loan crisis. We had unprecedented corporate bankruptcies. And you know, unemployment topped 10% then. Well, following that, we had 2011 and 12. That was Ebola. And then the U.S. faced a fiscal cliff at that time. And we had the Greek debt crisis. Then the U.S. was drawn into the Syrian conflict. Like that was 2011 through 2015, actually. Well, in each case, the events were different, but the patterns of the market were the same. What goes without saying, but 100% of the time when the markets went down, they went up, but they went up to new highs. Now, right now, we're faced with the coronavirus. We're faced with the uncertainties. What is fact? What's fiction? How is this all going to play out? The markets are responding to that uncertainty. And markets tend to overreact both up and down simply because they're driven by emotions. And then we have the uncertainty of oil prices. We have Saudi Arabia and Russia battling out with oil prices. And naturally, we have the upcoming presidential election in the fall. Well, I'm going to suggest those are similar in that they're events that will drive the market. Emotions drive the market. I would suggest we remember the other phrase, and that will be, this too shall pass. The markets will recover. They'll come back. Second of all, several reminders about how your portfolio is constructed and what we're doing behind the scenes. Well, first of all, your portfolio is carefully constructed based on the planning process that we've gone through that's designed to provide a confidence level to give you success towards your goals that we've talked about. You know, it's based on a customized portfolio based on, number one, your income needs, number two, your time horizon, your return objective, and your risk temperament. And we review that on a regular basis. Now, if any one of those has changed, please let us know. Well, the portfolio is also structured based on our experience over 3 decades at our firm in working with folks just like you that are nearing retirement or retired. So part of the product of what you're seeing in your portfolio is the experience we've gained over that time. And then we carefully research each and every manager that's in your portfolio, because we know that if you're like most of the folks we work with, you have three main objectives in this order. One is principal preservation and protection. Number two is income, and hopefully an inflation hedged income. And number three is growth. So we want that to be reflective of the portfolio of the managers that we select. Now, on an ongoing basis, we're meeting with management companies. We're making sure they deliver on those commitments. And then, as a reminder, your portfolios also, each and every fund generally pays a dividend or an interest rate. And what's happening is we're reinvesting those. So as share prices go down, folks, what's occurring is we're buying more shares at lower prices. So when they go back up, we'll have more shares. So that's embedded in your plan. Now, the other area, just to remind you of that we are here and that we are here for you. So anything comes up, if you want to talk to us, reach out to us by email, phone call. Don't hesitate to address any concerns during our planning meeting or during times between those meetings. Well, third and finally, what should you do during these times? Well, first of all, we believe we'll experience continued volatility in the days, weeks, and perhaps months ahead. I would suggest you be prepared for that. Now, the temptation is to wait it out. Well, I can assure you that research shows us over time, and our experience does, that in essence can be something that can interrupt your goals, because we have to make an important decision. When do we get out and when do we get back in? And also remember that your portfolio isn't completely tied to the stock market. It has various components for particular reasons that respond differently in different economic conditions. So it's really designed to mitigate the declines in the stock market. Well, I want you to keep in mind as well your long-term planning objectives. You see, our objective is to make sure that your portfolio lasts longer than you do. And we're going to go through these types of times. We're going through one right now. And folks, lastly, what you can do is call us and contact us once again if there's any questions whatsoever. You see, we're working for you. We want to be sure and make sure that our portfolio continues to reflect your unique goals, objectives, and risk temperament. So don't hesitate to reach out to us. Well, clients and friends, it's been great talking with you. I wish you all the best. Take care and good day.